session is about financing your company. So in the last session, we formed our company, and now we want to get some money in to get the company operating. So we'll see if I can work this out. It tends to want to cycle here. So the first kind of financing is the old-fashioned bootstrap financing. And what that means is that the founders form the company. They put their own money into it. They beg, borrow, steal computer equipment, desks. They borrow from their family and friends, and they get the company started. This is a very common way to start a company, and there's a lot of benefits to it. In fact, many VCs have told me that for software companies, they won't invest in a software company that hasn't bootstrapped. And when you ask them why, they say, because you can. A chip company, you can't. It takes way too much money to do a chip. But a software company, you can actually make a lot of progress towards your beta product with bootstrapping. And they feel that the struggles and the efforts that people go through to form a company where they have to pay out of their own pockets leads to a discipline and a culture that makes them much more successful at the end of the day. They feel that companies who get money too early tend to spend more frivolously and not budget as carefully. It's one person's view, or actually several people's view, but is one of the benefits to bootstrapping, I think, is you accomplish a lot. Also, you don't give up as much of the company as early because you don't have any outside investors who are sharing a piece. So a couple of things you want to think about if you do decide to bootstrap is to document it carefully. As you're putting money into the company, you want to keep track of it. If the amount of money coming in is different between the founders, you want to keep track of that. Now, you may decide, we're all going to put in $10,000, it's even, that's fine, we'll use it. You don't have to track that too carefully. But you would just add that as a basis to your stock. But if different people are putting in different amounts, you want to document it as a loan or have discussed what happens. Do they get extra stock for that money? Do they get the money back? One of the things, though, that you should remember is that it might not be repaid. It is not uncommon for VCs to come into a company and say, no, you don't get all this money back. You know you don't get back salary. That is all incorporated in the value that we're putting on this company. So you must keep in mind that if you're putting money in, you may never see it again until your company is very successful and you make millions of dollars on your stock. So you just have to have that mindset and keep it in mind and understand what your expectations are. And you also want to keep in mind, let's say you did start a company with two founders where it's 50-50. We talked in the last session a lot about how you figure out who owns what. But for this sake, let's say it's 50-50. And then one person has more money. So they have the ability to keep infusing cash into the company more than the other founder. You want to understand what that does to the dynamics, to the ownership. Have you agreed it stays 50-50 and that money is very separate and a loan, or does that person gradually get more and more of the company as they infuse more cash? So you need to understand sort of between the founders what the rules are of the game as the money comes in. And as I said at the earlier session, please feel free to ask questions as I go along. Makes the session more interesting. So next, if you either after you've bootstrapped or in lieu of bootstrapping, what do you do next? Often there's something called bridge financing. And what that is outside investment, but it's not done as a sale of a series of preferred. So often this is done if it's a small amount of money. Maybe you need $500,000 to get you to some milestone in which you can go out and raise venture funding. And usually that's a very important criteria because people want it to be a bridge to something. They don't want it to be a bridge to nothing. So if I give you $500,000 as a bridge loan, I want to know that that $500,000 is going to get you to some milestone which is going to make it easier for you to raise your next round. Otherwise, I'm sort of throwing my money away because you're going to use my $500,000, and then you get there, and then what? So also, bridge financing is sometimes done if you don't want to negotiate the terms. So maybe you're bringing in $500,000 or even as much as $1 million, and you don't want to negotiate with that person what all the terms are. So you call it a bridge loan, and you say that it will convert into the next round of financing. So when the VC comes along or the next big investor comes along, whatever terms they negotiate, I'll get as the bridge lender. So bridges can be two things. One, they can be really just a typical loan, which has interest and should be paid back. Or it can be a convertible loan where the person ultimately expects to get stock in the company. And that probably is the most common kind because the startup company doesn't really want to have to pay that money back because they're just going to need more and more money to get started, and they don't have any ability to pay money back for quite some time. So a bridge financing, there's usually a promissory note. There's usually a nominal interest. Usually people aren't in it for the interest, so it doesn't tend to be real large. If it's a pure loan, the interest tends to be much larger. And it has a conversion feature, which allows it to convert into the next round of financing. Sometimes it will convert at a discount. So let's say, I'm giving you this $500,000 today, and I'm taking a lot of risk, and I don't want to get stock on the exact same terms as the VCs or future investors who come down the line 6 months, a year later. So I want some benefit. I want to convert at a discount, maybe 80%, so I'll get more stock for my money. The other way to incent the person is to give them warrants. So instead of letting them convert at a discount, they get some warrants. So at the end of the day, when there's a financing, my $500,000 loan converts into stock at the price everybody else paid, plus I have some warrants to purchase more stock, which could be valuable in the future if the price of the stock goes up. And if you are planning on VC financing, in general, VCs prefer warrants to discounts. And the thinking there is that they don't really want someone buying stock at the same time they are at a cheaper price. But a warrant only has value if the stock has gone up and the value of the company has gone up, and so then they're happy for you to get the benefit of the warrant because everyone has benefited. Another important term for a bridge financing is the term. When do you have to pay it back? Is it a 6-month bridge? Is it a 1-year bridge? Is it a 2-year bridge? As the entrepreneur, obviously, you want as long a term as possible because you don't want to have it hanging over your head. As a bridge lender, you should keep in mind that even if you have a 6-month term, the likelihood of getting your money back is usually slim because the people have spent it.
Quick question. What's functionally the difference between a warrant and an option?
There really isn't a difference between a warrant and an option. They are both a piece of paper that gives you a right to acquire stock at a future date at a set price and a set number of shares. What's typically done, though, is options are usually granted to employees, consultants, boards, and advisors. And if they're incentive stock options, there's all sort of tax rules surrounding them. And warrants tend to be granted to outside people like bridge lenders, landlords, banks. But at the very heart of it, they're really the same thing. They're both a right to buy stock.
Is the warrant price in this type of deal usually set up to be the price at the VC price, or they're not set at that?
So a typical structure would be a bridge loan. I lend you $500,000, 6% interest, and I have a 15% warrant. So what does that mean? It means I take, let's say, for easy math, the Series A is $1. So I take $500,000, 15% is $75,000. I divide it by $1. So I have a right to buy 75,000 shares, if I'm getting the math right, of Series A at $1. And the warrant will usually be a 5, 7, or 10-year warrant. So on the day we close the financing, the warrant's no big deal. I mean, I could buy stock today at $1. So what? I have a warrant to buy it for $1. But a year from now, 2 years from now, when the company gets sold, when the company goes public, hopefully the stock's trading for a lot more, and I don't have to actually part with my money until I know there's an upside. And then some bridge debt. Oh, go ahead.
So the way this works is someone gives you a loan, right, as bridge financing, and then at the point where you're receiving your next round of financing, let's say from a venture capitalist, that initial person that loaned that money, they have the right to purchase additional stock, or does that actual loan, they kind of convert that to stock at that valuation?
Depends on how you write it. As the entrepreneur, you would like them to have the obligation to convert. So when I do my Series A that I talked about at $1, your $500,000 note now converts into 500,000 shares of Series A. Sometimes your note and interest. Sometimes the lender wants the right to convert. So you can choose, but you don't have to. You can tell me to give you your money back. Usually there's a threshold. So if there's an obligation to convert, the lender will say, I'll convert if you raise a financing of $2 million, $1 million, some magnitude. I don't want you to, get a buck from somebody, set some horrible terms, and now I'm stuck with that stock. I want to know that the financing whose terms I'm now going to have to live with is of a magnitude that I feel comfortable with. So it's pretty common for them to negotiate something like that. And then sometimes there are defaults. It's not that common in a bridge loan. That's more common in something like a bank loan. But it may say that if you do certain things, the money becomes immediately due and payable. So you should keep that in mind.
I know it's all negotiable, but could you give me an idea of what kind of an interest you would expect from somebody who gives you just money just below and somebody who wants a convertible loan?
Convertible is usually 5, 6-ish%. There's, depending on the length of the note and when you make it, you actually have to look. There's certain legally required minimums. Right now, I'm not really sure, but it's maybe around 5-ish. A lender who is just wanting their money back, they might want 10 or 12%. They might want 20%. You have to be a little careful. There's something called usury laws in California, which, are meant to keep loan sharks out, and so you have to make sure that you don't agree or ask for a rate of interest that's not allowed. Once again, calculation changes from time to time, but it usually would tend to be much higher because they're basically, their upside would be the interest, and they're taking a lot of risk. The person who converts their upside is the stock, so the interest becomes much less meaningful. Oh, okay, thanks. So that's a bridge financing. The next kind of financing is what's called angel financing. Angel financing tends to be maybe up to $1 million. Sometimes you'll find angel financing more than that, but it's not that common. Angels tend to be individuals who are wealthy and have money to spare and want to invest in startup companies. There are also organized angels groups. There's the Keiretsu, there's the Angels Breakfast Club, there's the Angels Forum, and they all operate differently. So if you're going out and getting angel funding, which is often a first step, you don't want that. It doesn't have to be $1 million. Sometimes people do, 500, 750, even 250. You should consider, see what contacts you have with people who might be willing to give you money, who might invest in startup companies. Look into the angels groups. You need to be careful. Some of the angels groups are actually a money-making organization. They charge you to come and present to them. So you got, and some of them are more of what you might think of. It's a group of angels who have organized themselves to invest together. They vary greatly at their degree of organizations. Probably the most organized one that I know of is the Angels Forum. They have a front office of people they pay for who review business plans, who work with entrepreneurs, and only once those people think it's of a caliber the angels will be interested in, they present to the angels. The angels can make individual decisions, but they tend to, invest in groups. And they also have a venture fund, very small, that invests so much. That's the most organized one I know of. Others are just a group of people who get together. You're presenting to all of them, and one or none or 20 can decide to invest any amount. There's the only organization there is that someone sets up the place, invites all the people, and brings in the companies. And then, like I said, some charge you. You got to keep in mind, it's not definitely or necessarily a bad thing if they charge you. Sometimes they charge a nominal fee as a way to make sure that the people who are coming and taking their time are serious about what they're doing. But you have to see how much they're charging. You have to see what you're going to get for it. You have to see if they're, make any commitments or what, ask them what the ratio is. Does 1 out of every 10 presenters get funded? If so, how many of your angels tend to present to them? If you're paying, know what you're buying. So spend some time talking to them and ask around, network, and find if there's other people who've dealt with that group of angels and see what they think of them. And also be careful. I put on my notes here, angel or devil. If you get 20 people who each invest $10,000 to get to $200,000, that's extremely painful. You may have to do it, but keep in mind that your smallest investor usually tends to be your biggest pain. People tell me, my clients, This guy put in $5,000. He calls me on a weekly basis to find out how the company's doing. The VC who puts in $5 million talks to me every other month. Why is this guy with $5,000 driving me crazy? So keep in mind the burdens and the benefits of getting lots of investors with small amount of money. So the next type of financing is the well-known VC financing. So VC financing is usually over $1 million. And actually these days the venture funds have grown so large that many of them tend to do only $3 to $5 million as a minimum. Because if you have $1 billion fund, you can't go out there making $1 million investments because you just are not going to have the bandwidth to look after all those companies. So many of them have a minimum of $3 million, $5 million. Some of them say, unless I can put $20 million to work over the life of the company, I'm not interested. So do your homework, find out the venture funds you're interested in talking to, find out what their thresholds are. So you may see that there's kind of a gap here between the $1 million for the angels and the maybe $3 to $5 million for VCs. There are some smaller funds which have popped up just for that purpose. They know that the big VCs want to put in $3 to $5 million, and the angels maybe go up to $1 million, so what do you do in the middle? So you need to do your homework once again and research and find one of those funds who might do $1 million or $2 million. Sometimes there's a bunch of smaller venture funds which will syndicate together, so you want to do that. So now I'm going to spend the rest of this session talking about VC funding, the things to watch out for, and what the terms are. So I'm going to go to this one, see if it stays there. Okay, so some key points to remember when you're getting venture funding. You need to raise enough money to hit a milestone that positions the company for the next round. Just like I talked about in the bridge funding, it has to be a bridge to somewhere. You want to make sure that you raise enough money to get to a milestone that's going to argue for a higher valuation in the next round. And you should always assume, I assume a 3-month slip-in plan. I don't think I've seen a company yet who has hit their plan. They always miss their plan. Everyone misses their plan. It's typical. You can't anticipate what's going to come up. You can't anticipate bugs or issues with development. It takes you longer to hire people. Somebody quits. So you always want to give yourself a buffer and raise enough money to get you to the next step. And the reason I raise that is people are always trying to maximize how much money they raise with how much dilution they take. So obviously the more money you raise, the more dilution you will take. So you have to balance those two, keeping in mind that if you don't raise enough and you have to do a down round, the dilution is going to be even more significant. So, nobody has a crystal ball, but you have to do your best to figure out what you think makes sense. And also, when you go out to the VCs, if you come to them with a plan that doesn't make sense, you're asking them for $3 million and it's not going to get you anywhere, they're not going to be that interested because they're going to know that it's just leading to a down round in the future. Also, term sheets with VCs are what I would call a prenuptial agreement. It's a way to get to know them. You want to make sure you're getting involved with the right firm, the right partner at the firm. You want to make sure you feel comfortable with that person. You want to value their advice. You want to feel like they know your industry and your company. And you want to make sure that the partner, let's say you're dealing with a partner in the funding process and you really like him or her, is that the person from the fund who's actually going to sit on your board? You don't want to get the bait and switch. You don't want to think, this person's great, and then at my board meeting suddenly it's somebody else. Now, obviously, I'm speaking from what would be a perfect world. You don't always get to choose who your VC is, but to the extent that you can, you want to get to know them and you want to be comfortable with them. You should also try to get multiple term sheets. You should, how much is your company worth? What is your pre-money valuation? Nobody really knows. It's just a question of what a willing investor will pay. And your value always tends to go up if you get multiple term sheets, if there's competition. But you have to be careful because you don't want to shop a term sheet. If a VC gives you a term sheet and then you take that term sheet and you show it to a bunch of other VCs, word will get back and you're very likely to lose the first VC. So it's, once again, a very delicate balance of trying to get multiple term sheets but not shopping the term sheet. And what we suggest is that people be talking to 10 investors at any point in time. Because You usually don't have the time to talk to one, see how that turns out, and then talk to the other, because that will take way too much time. On the other hand, you don't want to look over-shopped. If you go to the first 10 and they all reject you for the same reason, you want the opportunity to change your plan and change your presentation before you go to the next 10. And so what we do is we strategize with our clients to come up with a list of 10 they want to go to, and then your list of your next 10. And as one person drops off, you put one person on. So you kind of keep it going at all times. And even if a VC is interested and they've invited you back and they're doing diligence and you're on your third meeting, it does not mean that you're going to get funding. You should keep your options open. I mean, it's obviously promising, and it's a lot better than if they turned you away at the first meeting or didn't even take a meeting. But you always want to keep the irons in the fire until you get it resolved. And generally, you don't tell one VC what other VCs you're talking to, because otherwise they'll tend to get together and choose a price. You would much prefer to get two separate term sheets. Now, I said you don't shop your term sheet, but it is okay if you're talking to a couple of people, they're all interested, they're all having various meetings with you, maybe doing diligence, and one person gives you a term sheet. It is perfectly acceptable to go to the others and say, I now have a term sheet. If you're interested, hopefully you can put a term sheet on the table quickly so I can consider them both, because if not, I may have to go with this other person. That's okay to say. So it's okay to play them against each other a little bit.
What about in a case where you get a term sheet that's contingent on finding a second investor, and so the game is really showing that term sheet to the second investor to see if they want to join?
Well, that would be okay, because you would have discussed it with the VC who put the term sheet on the table.
Sort of a trick to avoid you from getting other primary term sheets?
No, not really. Some VCs will invest on their own, and some tend to always invest with others. A lot of it sometimes depends on the immediate cash needs of the company and the cash needs over time. Maybe you're raising $5 million and they don't want to put $5 million in. They'd rather do $3 million and have someone else do $2 million. They want deeper pockets because the company's going to need a lot of money going forward, so it's better to have two people at the table. So that's certainly something to think about, and that kind of segues into the next thing. A term sheet is a letter of intent. It's non-binding. It absolutely does not bind the VC to invest in you, but there is one provision, if they put it in there, which is binding, and that's what's called a no-shop. A VC often will put a term sheet on the table and say, in order for me to go forward and take the time, I want to know that you're not talking to anybody else. So whether or not you sign that is up to you, and you have to kind of think of what you're getting in return, because you're not getting a guarantee that they invest. On the other hand, they probably won't go forward if you don't sign it. So in your instance, if a VC puts a term sheet on the table with $3 million out of a $5 million round, says you need to go get another investor, they're not going to help you find that one, or they don't have anyone particular in mind, but they want you to sign a 45-day lockup. You really want to consider that, because they're really not coming to the table with a deal that they can do. It's incumbent on this mysterious second person. Now, if they come to you and say they're putting in $3 million, they want another person to put in $2 million, and they're going to set up meetings with a couple of venture funds to really help you find that other $2 million, then of course you're going to be much more inclined to go with them. So you have to kind of think of, if I sign this no-shop, which says I can't talk to other people for 45 days, what am I getting for it? Now, if there is a hole and you sign a no-shop, there always is a clause that lets you go talk to people. Sometimes you have to run it by them first, so you have to look carefully at what it says. Any other questions on that? Okay. So when you're negotiating with the VCs and waiting for it to scroll, and trying to determine your term sheet, the game is to minimize risk and not optimize success. So you don't want to negotiate every little point. Sometimes entrepreneurs will get really focused on every little issue, and you can't afford to do that, because you're negotiating with the VC right now. They're on the opposite side of the table from you. But if they invest in you, they're going to be on your board, and they're going to be working with you day to day, and they're going to have certain power over you in your life. So you need to maintain a good relationship with them. And VCs have often told me that, in large part, they've gotten interested in your company enough to put a term sheet on the table, but one of the key factors in their decision about whether or not to invest in your company is how you approach the term sheet, how you negotiate, what you negotiate. Do you seem to care more about yourself? Do you seem to care about your team? Do you seem to have a short-term view versus a long-term view? And I realize that's very difficult because obviously this is extremely important to you, and you want to get a setup that makes sense. At the same time, you have to understand that you're being closely watched, and what you choose to argue over will have some impact on whether the VC ultimately invests.
Talk a little at some point, about valuations and pre-imposed and
that is coming up.
creating.
It's coming up soon. So, in fact, I think it's next 2 pages. So quickly, I have, you need to understand that, yes.
The way you phrase that, they put a team sheet out and then they watch you, like they might not invest. How often does that happen? I mean, we've all heard and seen it.
If they go to the trouble of putting a term sheet on the table, they are very serious. And short of finding something they don't like, they will invest.
You can always find something you don't like.
Well, they're in the business. They're in the business. They've already met with you several times. They've met your team. They've talked to you. They've diligenced your company. They've talked to people about the market. So by the time they get to the term sheet, they're pretty sure they're going forward. But 2 things can happen between term sheet and closing. One is something turns up in the diligence that they didn't know about. And I can warn you, it's always a tough question if you have this little skeleton in the closet of exactly when to bring it out. You don't want to bring it out on the first meeting, but you don't want to wait till after the term sheet. So that will tank a deal after a term sheet is, some horrible skeleton or something they find out in diligence. And if the negotiations get out of hand or you can't reach closure on issues. So they're fairly committed when they put the term sheet on the table, but not 100%. I'd say maybe 85-ish, 90. And you have to understand the VC's model. They're in a hits business. They want a big return. They don't want, a market that might be a very healthy business and make a lot of money for a few people is not the kind of company they invest in. They need a big return. If you look at venture funds and their history, the success of a fund is usually driven by a couple of home runs. So they're going to want terms and they're going to want to make investment that allows them to get a big return. And so you should keep that in mind as you're dealing with them. And you should also keep in mind there's only 100 points of interest. We talked in the last session about how the founders divide up the pie. Then you layered on a 20% or so option pool. And now the VCs come in and they're going to take a portion. And this is your first round of financing. It's going to dilute as you go forward, which I have some slides on that in a little bit. So this is sort of a graphic of what's in a term sheet. There's a lot of provisions in the term sheet, and I won't go through all of them. A little further in the talk, I'll explain what some of them mean. But basically, divided them into 5 categories. So sort of the deal, the key deal points, the amount of investment, who the investors are, the type of security. It's usually preferred stock, but is it a senior preferred, that sort of thing. What's the price? And what does the cap table look like, which goes to valuation, which we're going to cover in a minute. Terms that are important to the investor is the liquidation preference, anti-dilution protection, who's on the board, what rights and restrictions and limitations do they have, what can they vote on, and what rights do they have. Right of first offer is the right to participate in a future financing. More operating terms, what's the vesting schedule for the employees and the founders, what's the compensation, does everyone have a proprietary inventions agreement? And then dividends tends to be a pretty minor term because nobody pays them. General voting rights. Registration rights are heavily negotiated but rarely used. And then co-sale rights, which are also rarely used. And then there's just some general provisions that are kind of standard. So the business rationale for the various terms, the liquidation preference is really a view of the long term. That's what the VCs and everyone gets on the way out the door when there's an exit event. And the liquidation preference is only relevant in an M&A context. If there's an IPO, everyone converts to common stock, and the liquidation preference doesn't have any meaning. Board and voting rights, those are really proper corporate governance. How is the company going to be run? Who's going to have a say? Who's going to have a vote? Anti-dilution protection is really a shared risk. What happens going forward? Do we have an up round? Do we have a down round? How many more rounds do we need? Then the registration rights, the right to participate in future offers, that's really sort of a path to liquidity because VCs don't invest in a company unless they see an exit. It's all about an exit at some point, either a sale or an IPO. Compensation, vesting, intellectual property are all sort of investor protections. Did I really get what I paid for? Valuation and price is really about the operations of the company, what they've accomplished. And then there's, deal terms, what is the security, and the no-shop and dividends and such. So let's get into some of the key terms in a financing. So first of all, what kind of security is the investor getting? As we talked before, in the bootstrapping and maybe even in the bridge financing, the people might be getting common. But in a typical venture financing, the VCs always get preferred stock. And what preferred stock really means is that they get their money out first. So how they get their money out and how much of their money they get out we'll cover in a minute in the liquidation preferences. But preferred stock is senior to common. It always gets its money first. It has certain special voting rights, and it's a separate class.
I think I missed it, but angel investors get common.
Angel investors would tend to get preferred. I think I might have skipped that in the angel section. Sometimes angels will do a bridge financing. It's another form of bridge financing. Sometimes angel investors will do their own Series A. Sometimes people will sell common to angels, but it's more common for them to get preferred. So the valuation, it's a key term in this. And what does it mean? And more important than what it means, what's in the valuation? So once again, who knows how much a company is worth? And it really depends on the stage the company's at, what the market is they're addressing, how much it's going to take to get them to where they need to be, how many people they've already hired, do they have their key people, do they still need to hire their key people? And all of those factors go into the valuation, and basically the VC picks a value and puts it on the term sheet. It's really not the best idea for you to go out and say, my company's worth X. You want to see what they put on the table. And what goes in, so the pre-money valuation is, let's say it's a brand new startup, the VC is investing, they say it has a $5 million pre-money valuation. What does that mean? That means that all of the stock that's out there, so the founder stock, the option pool that's been reserved, and any options, so a fully diluted capitalization is in the pre-money. One little twist there, the VCs will often say, you need to have a X percent, say 20% unallocated option pool when we close. So after the close, after the dilution that's created by the VC coming in, there still has to be 20% at that time that's unissued stock. So that's a algebraic formula to figure out, what's 20% post-financing. But that goes into the pre-money value. So they're saying, I want those options there, but I don't want to have to pay for them. I don't want to be diluted because of them. So that's something you have to keep in mind. You can't just look at that $5 million number. You have to see all of the factors that they're putting into the pre-money valuation. And then in my example, so you have a pre-money of a 5. If you raised 5, your post would be 10. The post is easy. It's just the pre-money plus the amount of money raised. Then the liquidation preference. That's a pretty key term. And that's what happens on an M&A. Now, sometimes people don't quite realize that because they think of liquidation in more of the typical use of the word. I'm liquidating the company. It's gone under. We've gone bankrupt. That's not when you care. A liquidation is also the sale of the company. So the liquidation preferences will say what happens with the money when we sell the company. So in my example, we did a Series A round. We raised $5 million. So very typically, the first $5 million would come what's called off the top. So let's say we sold the company for $20 million. So the first $5 million goes to the Series A investors. Then I've got 15 left. What happens with that? There's something called fully participating preferred, and that means after the A gets its $5 million, let's just say for easy numbers, the A is 50% of the company. They will get 50% of the remaining 15, and the common will get the other 50%. Sometimes the participation has a cap. So it would say the A would get $5 million off the top, and then they'd share 50%, until they'd gotten a total of 10 million, maybe 2x, that's called 2x, 2 times the amount of money in, and then all the money goes to the common. So if, in my example of selling the company for 20 million, the cap on participation really wouldn't matter. If you sold the company for 50 million, so you give 5 to preferred, and then there's 45 million left, and the preferred would get half of it till they got another 5, and then the rest would all go to the common. So you got to keep in mind the preferred can always elect to convert to common. So in that situation, they would cap out at 10 million, but they own half the company, and half of 50 is 25. So instead of staying as preferred, they would just convert from day one to common and get half of the proceeds. So as I know it's kind of complicated, I'm throwing a lot out there at once, but when you get the term sheet, you want to sit down, do some spreadsheets, run some money, examples, make some assumptions, and kind of you really want to understand how the money will flow. I have had instances where a company is sold and the money gets divvied up, and the founders really didn't understand that that's what was going to happen at the end of the day. So you want to make sure that you do. And as an entrepreneur, you want the preferred to stop sharing at some point, because you want to say, if I make enough value out of this company, I don't want you to get your $5 million off the top. I just want you to get your percentage interest. We should all share and share alike based on whatever our ownership is. And in the A round, it might not sound so big. It's $5 million off the top. You sold it for $50 million. But you have to remember that you're going to have your A round, you're going to have your B round, you're going to have your C round. If you raised $5 million at the A and $10 million at the B and 15 at the C, now you've got $30 million, which comes off the top. So you have to keep in mind that it's additive, and you want to understand how it's going to work and how the money's going to flow. So the liquidation preference is obviously a very key term because it talks about how the money will flow. As I mentioned, if you do an IPO, all of the preferred converts to common, and so everyone just gets their percentage interest. So the liquidation preference doesn't really hold a lot of weight on an IPO. It's meaningless. But on an M&A, it does. And I'd say 80% of startups get sold versus going public. So it is a very real thing to think about.
I have a question. So say I'm an early stage entrepreneur and I get either private placement or others. I get money from other people, I get money from my family or friends or whatever. How their equity share is affected when the company either goes public or goes through an M&A process? Is there any difference?
Well, it depends on what kind of stock they have. If they have common stock, they'll receive the same treatment as everyone who has common stock, which would tend to be the founders and employees. If it was a bridge, if you brought it in as a bridge financing, which converted into Series A, they would get the same treatment as the Series A holders. So it doesn't really matter who they are. It matters what type of stock they ended up with. Any other questions? Beth?
What would you say the range is? How high does it go? 2.5x, 3x? Does it matter whether it's Series A or later round?
That's a good question. It ranges depending on the market and the times. During the bubble, 1x off the top, no participation was pretty common. Then during the bust, I saw as bad as 7x off the top, but I only saw one of those. I would say, and now I would say in general, it's pretty much 1x off the top. Every now and then you'll see a 2x or something, but not that often. And then I would say the average now is 1x off the top, sharing for 2 or 3x. But it usually, in future rounds, sometimes if maybe the company gets a particularly high valuation, the investors will say, okay, we'll put in this much money, but we want our money back first, and we want 2x. So future rounds can end up with different terms, sort of depending on the circumstance the company's in at the time it raises the money. Okay, so other terms. This is so equity conversion for it's not ISPs, which are internet service companies. It's supposed to be VCs. I don't know how that switched up there, but sometimes VCs will come in at later rounds, and they will say, we don't want all of this overhang of all these VCs who came before because the company really, it's maybe a restart or it's not done as well. So sometimes they will require old preferred to convert into common. And that's just something, if you're in later rounds, you have to think about. You have to understand how it affects the common, how it dilutes the common. Usually in that situation, the common who are still employed at the company will get new options. It's called refresh grants. But if you're a founder who has left and that happens, you often get seriously diluted. So that's another reason to, be careful with your valuations. It's not always about getting the highest valuation. You may get two term sheets on the table. One has a higher valuation than the other, but you respect the VC who had the lower valuation and you think they'll bring more to the table. So you have to weigh those things. And you also, if you get some random really high valuation that you don't think you can do better the next round, you have to keep that in mind because that can ultimately lead to some of these conversions and dilutions. So anti-dilution is a provision that is in the preferred, which basically says if you sell stock in the future at a price lower than what I paid, you need to make me whole. And there's a couple of different ways to do it. First of all, you carve out things like options because those are definitely going to be lower. There's certain things that are carved out that are expected to be issued at a lower price. But they don't want you to do a financing at a lower price. The most draconian form is called full ratchet anti-dilution. So if I paid $1 a share and you do your Series B financing at 50 cents, I get anti-dilution protection down to 50 cents. And what it means, a common misconception means I get more Series A preferred, and that's not exactly how it works. I just get a right to convert into more common. But it gives me benefits on voting, and when we're, after we took our 1X off the top and we're sharing, I get more. So that's called full ratchet. Probably a more common is called weighted average anti-dilution. And what that does is it's formulaic, and it says how much stock did you issue, how much stock do you already have, what was the price relative to my price, and it's like it says, weighted average. So it takes into account all that stuff. So if you issue a few shares at 50 cents, it doesn't really do anything for me. If you issue a lot of shares, I'm going to start to get more and more benefit. Was there a question? Oh, okay. Then sometimes there's a pay-to-play provision. You may have heard of those. As an entrepreneur, you don't particularly care about that. That's really just a provision among the VCs where they say, okay, everyone who's in this round, if you don't put your pro rata investment in the next round, you might get converted into some lesser form of preferred, or you might get converted into common. The benefit to the entrepreneur in that situation is simply that there's more pressure on your investors to keep investing in subsequent rounds. But it's not something that you care too much about. Tranching is something that you do care about. A trend that has developed, I wouldn't say it's in every term sheet, but you see it more often, is to fund the money in tranches. And actually, in the form of term sheet that I passed out, it does have 2 tranches. And the idea being that I give you some money now, and then if you meet certain milestones, I'll give you the rest of the money. Obviously, as the entrepreneur, you don't want that. You want all the money now. You don't want any conditions or anything standing in the way of you getting the next tranche. If you have to agree to it, sometimes you do. That's the money that's on the table. That's the terms that they ask. You want to make sure that the milestones are ones you believe you can meet and that the milestones are very clearly defined. You want to make sure that someone who doesn't know anything about your business could pick up the milestones and determine whether or not they've been met. You want them as objective and clear as possible. So that's something to be careful of. And then, as we talked about in the last section, the founder stock restriction agreements and vesting schedules, sometimes VCs will come in and they will want to impose additional vesting on the founders if they don't think there's enough. And that's just something that you're going to have to negotiate. And you're going to have to keep in mind if there's more than one founder, it's an individual negotiation with each. So let's see, if you have 3 founders, each person has the ability to tank the deal if they don't agree. So you kind of need to talk about that and make sure you're all on the same page. So pari passu is a term used among various series of preferred. So it means equal in all respects, and it ranks the preferred. So if the Series A preferred and the Series B preferred are pari passu, that means they share equally. So in my example, we sell the company for $50 million. The A gets 5, the B gets 10 at the same time. And in that example, since there's enough money to go around, the pari passu isn't really meaningful. If we sold the company for $10 million, and the A is entitled to 5 and the B is entitled to 10, the A will get 1/3 and the B will get 2/3. And then sometimes subsequent rounds are senior, so the B gets its money out first, and then the A, and then the common. So you just want to understand how it works and what the ranking is. Once again, you don't care that much as an entrepreneur. I mean, they both get their money out before you do, so do you really care that the B gets it out before the A? The only reason you might care is you have to look at the voting power of the people and what the motivations of the person who gets their money first might be, and make sure they're aligned with yours. Voting thresholds, as I mentioned in the last session, that under the corporate code, votes are a majority. To pass an item that requires shareholder consent, you need a majority consent. So the preferred will go in and make certain thresholds of what you can't do basically without their consent. So you can't sell the company without a majority of the preferred approving it. You can't change your line of business. You can't incur debt. You can't do a future financing round. So you just need to understand you don't just look at the percentage of the company they're getting. You look at what control they're getting and make sure that you understand that. And as an entrepreneur, once again, if you have more than one series of preferred, you much rather they vote together. So you would much rather it say, I can't sell the company without a majority of the preferred versus I can't sell the company without a majority of the A and a majority of the B, because then you need two different constituencies. You need to pass two different thresholds. And then the legal fees get you coming and going. As the entrepreneur, you pay your legal fees, and you also pay the investor's legal fees. Now you're using their money to get it, pay it, but you give them stock for it. And that's something that a lot of entrepreneurs don't know is standard and they find kind of offensive. But it is the way it is. Board structure. Board structure is a very important term in the financing. Who is going to hold the seats? So I put up here an ideal board is 2, 2, and 1. 2 preferred representatives, 2 common representatives, and 1 mutually accepted independent person. Now you may say that's not an ideal board structure. I want 3 common and 1 preferred. My experience past, probably 5 years, it's incredibly uncommon to bring in outside financing and have the common still control the board. The best that you can hope for is that it's an even split, that the preferred don't control it either. There are the exceptions, but it's the norm now that it's a pretty balanced board. So you have to understand not only who is going to be on the board at the closing, but who has a right to fill those seats. So the preferred would usually, if we just have A, the A would get 2 seats. If we have A and B, probably the A gets 1 seat, the B gets 1 seat. For the common reps, you want to understand exactly who controls that. And what you want is that it's a common stock vote. Sometimes they will overlay on it that one of the common seats has to go to the CEO. Now, it's very common, and if you're the CEO, you're fine with that. But you might not be the CEO forever. And if you're not the CEO, it's pretty likely that the person who's brought in to be the CEO is someone who the venture capitalist selected. So that's not really a common seat. It is temporarily, but over time it might not be. So you have to understand, and I'm not saying never do it because lots of companies have it, but sometimes what you put in place is if the founder is no longer the CEO, we'll create a new seat for the CEO, because the CEO is almost always on the board, so he or she needs a seat. But the question is, do you as a founder have to give yours up for him or her? And then one seat, it's always nice to have sort of an outside viewpoint, an industry expert, a person who really has no vested interest in, preferred or common, but really is just looking out there to guide the company and look for its success. So sometimes it'll be someone who can be sort of a mentor to the CEO if the CEO's a first-time CEO. So you try and set it up so that that person is jointly elected. Now, once again, you have to be careful because if the language says he's just elected by all the shareholders, but the preferred have a majority of the shares, then it's really, once again, a preferred seat. So you want to make sure that the language is carefully crafted so it really is someone that both the common and the preferred agreed to. Sometimes you'll say the other 4 directors have to agree on the person. Sometimes you'll say a majority of the common and a majority of the preferred have to agree on the person. So, as I said, the board's role is to oversee the company and hire and fire the CEO, approve budgets and operating plans. It is not to micromanage the company. So you want to make sure that the board is functioning in that role, that the people you put on the board will view it that way. And then the outside investor really wears 2 hats because they're trying to be an overall board member, and then they're also trying to keep kind of the 2 constituencies working well together. And one of our points is to avoid the mushroom management, keeping your board in the dark and just sort of telling them the minimum of that they need to do is not something that we recommend. We recommend working with your board, communicating with your board, but that's really, I've done whole other sessions on board management. I just wanted to throw it in there that one of the traps that first-time CEOs often get into is sort of mismanaging their board. And so it's a very important relationship that you want to think carefully about and make sure to the extent you can that the people on the board are people that you can work with and have an open and communicative relationship with. And then in this instance, so the advisory board is in addition to your board of directors, and they tend to be outside experts who can bring various things to the table, maybe technology advice, maybe relationships, maybe introductions to potential customers. So that's where you put your sort of technical thought leaders. So here's my picture of the perfect board. Yes? Mm-hmm. So directors who came from venture funds don't usually get stock compensation because they bought their seat through the venture fund. Their upside is the success of the preferred. The inside director, so my picture, the CEO and the founder, they're going to have their stock compensation in connection with their employment. They don't get any separate stock for being on the board. So in this picture, the only person who's getting stock for being on the board is the outside director. And they would get some percentage of stock, usually vests over, say, 2 years. And advisory board members also would get stock, usually less than board members, and that usually also vests over maybe 2 years because you want to make sure they actually help you in the way that you had hoped. So one of the things that we talked about was dilution. And it's really hard to know from the beginning what the dilution is going to be. And, as I mentioned, I think earlier, people come to me just starting the company, and they have this chart that shows, here's the founders, here's the Series A, here's the Series B, here's the Series D, here's when we sell, here's the percentage we're all going to have, and here's the money we're all going to make. The only thing I can tell them is that it's not going to look like that. I don't know what it's going to look like, but it's not going to look like that because you just don't know. The percentage of dilution is completely dependent on how much money you have to raise, what the valuation was when you raised it. So if you raise less in your Series A, you're going to have a higher percentage. If you raise more, it's going to be lower. But you can't just focus on percentage ownership because time to market may be everything. It's much better to have 5% of something successful than 50% of something that fails. So you have to think through the dilution and balance that with what you need the money for, how you're going to spend it, how quickly you need it, and whether you can kind of go along bringing in little pieces to minimize dilution, or if you need to just suck it up, take the dilution, get the money, and get to market. So I put an example in here of one of my companies. So they did their Series A financing. The Series A had 47% of the company. The common had 45.6%, and the options were 7.25%. Now, in this instance, the options are pretty low for a Series A company. They had Bootstrap for quite a while. They had done a lot of the hiring they needed to do. And one of the things you can do to negotiate with the investors when they come in and you're negotiating about what the size of the pool is, I always recommend to my clients to make a stock budget for the next 12 to 18 months and show who you're going to need to hire and how much stock you're going to need. And if you go with a reasonable budget showing, I don't need to hire that many more people, and the people I need to hire aren't going to take big equity positions because I've already done it, you can get away with a lower pool. So in this instance, the pool was 7.25%. And, The VCs have slightly less than half the company. So then they did a Series B round, and you can see the common's still holding up pretty well at 34%. The Series A has 35, the B at 20, and now you see the option. You say, oh, the option pool went up. What happened there? The investors, when they came in at the stage of where the company was, they said you have to increase your option pool. So the option pool was increased, and like I said, it would have gone into the pre-money valuation, so causing a little more dilution at the Series B financing than if the pool had not been increased. Then they did the Series, trying to keep this from scrolling. They did the Series C financing, and you see the common's still holding up okay. They got 32%. The options are now 22%. You're like, what's going on? It keeps growing. But the company was growing. They needed to do a lot of hiring. Some of the key founders had left with chunks of stock, and they had to be replaced. And so the option pool had to grow. And then they did the, gone the wrong way. Then they did the D round. That was not a pretty round. The company had really faltered. It was basically a complete cram-down financing is what it's called. And the Series D took 98% of the company. And you may say, why did they bother? Well, you look at that, and it's just so minimal. What's the point? And amazingly enough, here's the point. They went public. They got the cram-down financing. They were able to pull themselves together. And about a year later, they went public. And as I mentioned, the preferred all converts to common. And now that 65% of common you see, that is the founders, the employees, the A, the B, the C, the D. But they have 65% of the company. They all did quite well. And they sold 25% of the company in the IPO, and they had 9% as their option pool. So this is just one example of one company, and every single company, you would do a pie chart, and it would look different. But that's just to show you that how the dilution evolves, and even sometimes with a lot of dilution, you still end up doing okay. So pretty much. So they were much better going public than having merged.
Didn't D really still get all the benefit because when we talk about the people who had it, that all converted to common shares, right? So the 65% that includes what looked like the 98% with earlier financing.
The valuation was high enough that everyone did quite well. The D, of course, did the best, but the founders are all quite wealthy and not too unhappy about life. I mean, obviously, you always want more, but it still ended up being a success story for them. But you're right, the D got a big chunk of that, 65%. Yes?
You said you need to take that into account for the pre-money valuation, but that's not as far your new employees.
That's right. So that's one of the twists when you're figuring out the pre-money valuation. The VCs will, the existing option pool goes into the pre-money valuation, and the VCs will require that any increases to that pool that they're requiring as part of the term sheet go into the pre-money valuation. They basically are saying, for the value I'm putting on the company, this is what I want it to look like. I want it to be a company that has sufficient options for all the people who are going to be hired, because I know you're going to have to do it. I don't want to personally suffer the dilution, and so you basically have to bear it. So but it's something you have to make sure when you look at the valuation that you're truly understanding what you're getting. So just to kind of wrap up, there are other investors out there other than VCs. I know we've spent a lot of time talking about VCs, and I do that because that's sort of the most typical, and it's also sort of the most complicated. But corporate investors are not uncommon. Corporate investors tend to pay higher valuations than VCs, so a lot of people like that about them. They tend to have less day-to-day involvement. They may sit on your board. They may not. They may just want to be an observer. They tend to not bug you as much day-to-day. But there are other issues. Corporate investors aren't perfect. And some of the issues are board confidentiality issues. So you've got them, if they're on the board or if they're observer, they're in the boardroom, and you're talking about things about your business that maybe you don't want them to know, because you don't want them necessarily to know what your margins are. You don't want them to know what your development plans are. You don't necessarily want them to know what other people you're selling to. You also can have conflicts with customers. Your customers say, you've got so-and-so as your lead investor, you're likely to be acquired with them. I don't want to buy from you because then I don't want to be beholden to, that's my rival. I don't want you to be owned by them, so I don't want to buy from you. And there can be conflicts on exit. Corporate investors sometimes invest in startups to make money, but in large part, they invest in startups to have access to technology and to see what's going on in the market and things like that. So if that is their motivation for investing, they may have different views on when you sell, who you sell to, than the founders and the VCs who maybe want the cash out exit. Maybe the arch rival of your corporate investor wants to buy you, and they'd much rather see their investment go down the drain than have their arch rival have this technology. So there can be serious conflicts on exit.